YouTube channel. First of all, thank you for all the people to watching my videos, also liking and commenting on that videos. Also guys, don't forget to subscribe my channel. So this is the third videos of my series of the basic to pros the share basics of share market. So today I will explain first the what is the agenda of this these videos, and after that I will explain one by one. So let's start first with the what is the agenda of these videos. So basically, first is what is meant by derivative. What is meant by derivative? After that, what are the derivatives? After that, what are the derivatives trading ways? There are two types of trading ways: over the counter and exchange traded derivative. After that, types of financial derivatives. There are many financial derivatives, but they mostly these four are the most usable derivatives like futures, options, forward, and swap. After that, what is difference between futures and options? And last one is what is difference between equity and derivative market? So this is basically today's video's agenda. So let's start first, like one by one. Let's moving right to the next slide. So first one is what is meant by derivative, right? So basically, derivatives are contracts that derives their value from the underlying asset. This is the most important line and most important thing in the definition of the derivative. Derive their value from the underlying asset, right? So let's start with one example. Basically, let's consider this is a one apple. This is the apple, right? Apple farm, and from this apple we are making the juice, right? Sorry for the writing. Then yeah, overall apple prices goes up, then juice prices will be up, because juice prices will up when the apple prices goes up, means this juice derivative derive there is value from the underlying asset. And what is the underlying asset? This is apple. This is the underlying asset basically. Let's one more example. So this is a let's consider the Reliance stock, assume for the example. So this is a Reliance stock, and this is a Reliance future. Let's consider, yeah. So Reliance future prices will be goes up when the Reliance stock prices will be goes up, means this Reliance future derive the value from this underlying asset, this asset stock, Reliance stock original. So this is basically definition of the derivatives. Derive their value from the underlying asset, right? After that, these are widely used to speculate and make money, right? Let's consider uh, A party and this is a B party, right? So A party buy the contract, like buy the future contract at a predetermined price and date, means today is the 1st July, and end of this contract is last Thursday of this July months, right? So A party wants to Reliance Industries future. Today's price is 2000, so he want to buy for 2000 price into some lot 10 quantity at the future date, right? And in case the market, this is a party speculation, and at the end of this contract the market goes on his A party side, in the A party's direction, then A party will be win, because his speculation is correct, and then A party is a profitable and B party is making the loss. So this is a basically speculation and make money example for the this stock. After that, a financial instrument is a real or virtual document. Means when he buy this contract, that time stock exchange send the one document on our mail, and this is a virtual document representing a legal agreement involving any kind of monetary value. This is that the legal agreement involving any kind of the monetary value, right? As I said in the, let's see the image. This is underlying asset explained. Derivative derive their value from which this is from the underlying asset, right? What are the underlying asset? Currencies, stock, bonds, indices, right? And let's also I want to inform you more information like history of the derivatives. So the history of derivatives dates back to 1930, right? Where the Dojima Rice Exchange was formally established in Osaka and allowed for rice exchange. Means history of derivative when start from 1930s in worldwide, and where the Dojima Rice Exchange formally established in Osaka allowed for the rice exchange. So this is basically in our India when start in 2000 NEC started with index future, and after 1 year in 2001 NEC started with index option. So this is basically history of these derivatives. So let's start with like what are the derivatives. A derivative is a financial contract that derives its value from the underlying asset. I'll explain the meaning of this derived its value from the underlying asset in the apple and this example. After that, the buyer agrees to purchase the asset on a specific date at a specific price, right? I already explained this example. A party and B party means A buyer agrees to purchase the asset at a specific date, means last Thursday of this month, and specific price means this is 2000, right? After that, the asset includes commodities, stocks, bonds, interest rate, and currencies. As I said in this image, and what is the underlying asset? Currencies, stocks, bonds, indices. After that, derivatives can be used either for risk management or speculation. As I said, in the A party speculate the market goes up at the end of the contract. So that's why he wants to buy 1 month before the today's basis by this contract. So this is basically speculation or risk management. So let's start like what are the derivatives? The example like shares compared with the shares and land. Shares are the derivatives? Yeah, of course, yes, because shares is asset and tradable. So derivative should be asset and this should be tradable. That are called the derivatives. But in land case, land is asset but not a tradable, right? So that's why land is not a derivative. So this is basically what is meant by derivatives, what are the derivatives, and these are the example, and what is, and this is the history. So let's moving ahead with the next trading ways, right? So trading ways, there are two types of the trading ways. First is over the counter, and second is a exchange traded derivative. Basically, over the counter, basically this over the counter is usable in the forward and swap contract. An exchange traded derivative used in the futures and options. So let's start with the definition. Over the counter derivatives are like special financial deals made directly between two parties, right? This is a deals made directly between two parties without using a regular marketplace or middleman. The special thing about them is that they do not have a fixed rules. Instead, the two parties can decide the rule themselves. This is basically definition of the over the counter. And basically, this is a deals made directly between the two parties, right? Without using a regular marketplace or middleman. This is the special thing about that about them is that they do not have the fixed rules. Instead of two parties and decide the rule themselves. Let's start with one example. Let's consider A. A is Abhishek and B is Rahul, right? So Abhishek have a farm of the turmeric. So he wants to sell this farm as the today's basis with some amount because after 2 months the turmeric farm prices will be goes down. So he wants to sell today's date to some price. Let's consider 1 lakh price or whole farm price. So he wants to sell this farm to today's basis after the 2 month, right? And he party agrees with the buy this farm as the today's base with the 1 lakh amount uh, at the future date today means after 2 months. So this is basically deals between the two parties but without using a regulation without using a regular marketplace or middleman. This is the and in that they do not have the fixed rules. Instead of the two parties can decide the rule themselves. So that's why they're risky because B after the 2 months this mind B means Rahul guys uh, mind will be changed after the 2 months and they will be manipulation for this contract. So that's why this is risky. But in an exchange traded derivative, an exchange traded derivative is a standardized financial contract that is traded on a stock exchange in a regulator manner. Basically, this is a standardized financial contract. Over the counter is a non-standardized financial contract and is traded on a stock exchange in a regulated manner. They are subjected to the rules drafted by market regulators such as Security and Exchange Board of India. Means this exchange traded derivative regulates who regulates the SEBI because the SEBI has their own rules and these rules follow these apply the rules on the exchange traded derivative. So this is basically not risky, right? After that, uh, let's start with one example. Like let's consider also A is Abhishek and B is Rahul. So let's consider one example for the Reliance contract, right? Reliance future contract. So A party, A means Abhishek wants to buy this Reliance future contract with a 2000 price. Let's consider 2000 price one shares. There are in the one lot there are 10 quantity. So he wants to buy 2000 of price with one lot at the today's after as the future price as the future date, right? And the future date will be like end of this month, last Thursday of the month will be expire date of this contract. So he wants to buy for the at 2000 rupees at when at the last Thursday of this month. So this is the contract on the exchange traded derivative board. This is these are fully standardized contract between Abhishek and Rahul because they traded on the stock exchange and they have the uh, original proof regarding to the original original bill original documents from the stock exchange. That's why this is not risky between the contract between the Abhishek and Rahul. So this is regarding to the exchange traded derivative. So let's difference between these two types with basic of a comparison. So first is a meaning. What is meaning? Like for OTC, a decentralized dealer market, because this is non-standardized, so there's investment-based dealer market. And a organized and regulated market. This is a standardized regulated market because SEBI regulates this market. After that, market maker. This is a dealer in between the dealer and this is the exchange itself only, right? After that, this used for the small companies and this is well established companies. Trading hours is 24 hours and this is only exchange hours. Contracts, these are the customized, these are the standardized, right? Transparency, as I said in the examples, there is a chances to the manipulation from any of the parties, so that's why the transparency is low in the over the counter. And this in the exchange, the SEBI regulates, that's why the transparency is high, because SEBI has own rules and they follow to the exchange, they needs to follow to the exchange derivative. So that's why this is a high transparency in the exchange derivative. So basically this is a two types of the trading ways and where they use and what are the like uh, pros and cons in the two types of derivatives. So let's start with the let's move with the so let's start with the like types of the financial derivatives. So as I said last video, last slide, so there are many types of the financial derivatives, but most usable are the fours, like futures, options, forward and swap, right? So future and options are the exchange traded derivative and forward and swap are the over the counter trading ways, right? So let's start with the first futures. A future contract is an agreement between two parties to buy or sell an asset at a certain time in the future, at a certain price. So agreement between two parties to buy or sell an asset at a certain time in the future at a certain price. This is the important part of this definition. Let's start with one example. Let's A is Abhishek and B is R is Rahul, right? So let's start with the one popular example like Reliance Future, right? So Reliance Future, like Abhishek wants to market will be overall market will be goes up, so Reliance Futures will be goes up at the end of this contract. So consider today is the 1st July, right? And end of this contract means last Thursday of this month. So the like three types of the contracts, like first is a near month, after that next month and far months, month first, second and third. There are the, monthly contract likes. So he wants to buy Reliance Futures with like today's price in the future date. Means future date means last Thursday of this July month. So he wants to buy it like one lot. In the one lot there are total 10 quantity and today's price is a 2000, right? So he wants to buy this price and the future date. So in the today's price he wants to buy, so he needs to pay the some margin. So in the overall amount we will not pay B, because in the future there are more values, like big values to the, but yeah, so in the stock exchange you're available to pay only margin as the today's base in the future date, today's price the future date. So he needs to pay this some margin like a whole amount of this 2%. So this is called as margin to pay to a Abhishek. So on the today's price at the future date, right? After that, future contracts are financial derivatives that oblige. the buyer to purchase some underlying asset or the seller to sell that asset at a predetermined future price date, right? So this is the important part in the financial derivatives that oblige the buyer to purchase some underlying asset or seller to sell that asset at a predetermined future price and date. So once the Abhishek enter in the contract and Rahul also enter in the contract, both our parties can't back out from this contract. Abhishek needs to means oblige the buyer. Abhishek is a buyer, right? So oblige the buyer to purchase some underlying asset means he needs to buy the stocks, buy the futures, realized futures, right? And seller to sell that asset means seller to sell that realized futures at a predetermined future price and date means 2000 predetermined future price with date like last Thursday of this contract. After that, future contract to hedge against risk or speculate on the price movement of the underlying asset. As I said, this is a speculation purpose. Like Abhishek speculate the market will be or market will be goes in the end of this month, right? So this is a speculation wise, and in that case, really last Thursday of this month, last Thursday of the expiry, of this contract. So really market will be goes up means it has a market will goes up in the Abhishek direction, right? So really, Abhishek will be win the bet, and Rahul will be lose the bet. At the end of this month, the value will be like 2,100. So Abhishek will be making profit like 2,100 minus 2,000 is 100 into lot size 10 quantity. So he will be profit at the end of this contract means he win the bet. Abhishek and Rahul lose this bet. This is like a good example for the futures. Futures are standardized contract and traded on a centralized exchange. These are traded on the exchange rate of the derivatives. After that, the future contract can be considered a sort of a bet between two parties, right? This is a bet like first Abhishek speculate the market direction, and he wants to contract between the Rahul. That's why these are the bet between the two parties. Needs to major keys of this future contract regarding to the like futures are the derivatives financial contract means this needs to be follow these three steps. First, oblige the parties. As I said, once they enter both parties, they can't back out. So like buyer to purchase some underlying asset and seller to sell that asset. Transact an asset means Reliance features this an asset like an asset will be uh, like asset like the like stocks and pure commodities and index and future. They're like and at a predetermined future date and price means Abhishek wants to buy today's price is 2000 price and he want to buy at a future date. That means last Thursday of this month. So this is a future date and future at today's price like future price like 2000, right? So these are the uh, seller and this is a buyer and this is a sign of contract between the trade underlying asset in a particular quantity at a predetermined price and date, right? Predetermined price means 2000 is a predetermined price, right? At the future date like is the last Thursday of this month. On the today's base, predetermined price 2000, right? And uh, after that, and what are the asset like commodities, index funds, currencies, pairs, minerals, stock indices, cryptocurrencies, treasury bonds, like future contract like currency futures, index futures, commodity futures, and stock futures. This is overall regarding to the future contract, and this is a good example for the future contract. So let's moving on to the next slide. What is meant by forward? Forward is basically same with future contract, but difference is a forward contract is a non-standardized contract between two parties to buy or sell an asset at a specified future time at a price agreed upon today, right? As I said, in the future contract is a standardized contract, but the forward is a non-standardized contract. So, like the key difference being, unlike futures and forward contracts are not traded on exchange rather than the over the counter, right? And they also forward are used to hedge risk in commodities, interest rate, exchange rate, or equities. So this is basically non-standardized contract and not a regulated manner, like between the two parties, right? Let's start with the one example. So this is a contract between the two parties, right? This is a Ritik and this is the Abhishek. So Ritik agrees to buy gold at $3,300 per ounce delivery price, and when the 3 months from today. So he agrees to buy, and Abhishek also agrees to sell gold at $300 per ounce delivery price. Delivery price when 3 months from today. This is the agreement between entails between the two parties, but this is not a regulated manner, non-standard way. This will be risky because after that, after the 1 month or 2 month, Ritik don't want to be by this, right? And he don't want to be like means he is manipulate. And he don't want to buy. So this is a risky uh, in between the contract, right? Like so, basically, this is a good example for the forward contract. And so let's moving ahead to the next swap. What is swap? Swap is basically most often a contract between two parties agreeing to trade loan terms. Basically, these are the made using for the interest rate, currencies, and commodities. So today I will explain the one example regarding to the interest rate, regarding to the trading loan terms, right? So, like a trading derivative contract through which two parties exchange the cash flow and liabilities from two differential financial instrument, right? So let's start with one example. So she is a she is a Ananya and he is a Abhishek, right? So Ananya wants to buy the property, means buy the flat, right? And for this flat, she needs to money and taking the loan from any bank, right? With like interest type, like with fixed fixed interest rate. And also Abhishek wants to buy the property and flat means, and for this property he taking the loan from the bank at variable interest rate, right? This is example, like, and one might use an interest rate swap to switch from a variable interest rate loan to fixed interest rate loan, or vice versa. Means uh, once both parties are taking the loans, but after some time she wants to uh, shift it to the fixed to variable, and he wants to variable to fixed, right? And how to do that? Through the swap contract, right? This is basically swap contract. They, because this will be doing through the swap contract. And how? I'll explain this uh, next line here. If a person might seek to switch their variable interest rate loan with someone else who has a loan with fixed interest rate that is otherwise similar. Means both parties will swap only the interest rate, not a principal amount, right? And these loans will be both the loans should be same, because this taking the home loan and this he also taking a home loan. So the purpose of this taking loan or taking loan is should be same, right? And price should be also need to same, because he is taking home loan for 50 to 50 lakh, and she taking home loan at 50 lakh, and he taking loan for home loan at 49 lakh. So price will be near, but same price will price should be same, right? So the loans will be remains in the original holder name, and the contract mandate that each party will make payment towards the other loan at the mutually agreed upon rate. Means there is a mutual understanding between the two parties regarding to the swap. Yeah, she wants to put the fixed to variable, and he wants to variable to fixed. This is a mutual understanding between the two parties, and only what can swap only the interest rate, not the principal. The amount uh, remains same, only interest rate swapping, right? And the swap can be risky, because if one party defaults or goes bankrupt, the other will be forced back into the original loan, right? Because this is not a standardized way. This is a non standardized way, right? So after some time, after 1 year, he wants to uh, need to fixed to variable also, like he wants to did the default interest rate, then automatically she will be forced back into the original world. So this is a risk between the two contract, right? And after that, the swap can be made using interest rate, currencies, and commodities. So this is basically swap. After that, now let's move ahead to the next. What are the options? So basically, option option is like option is a similar to future contract in that it is an agreement between two parties granting one the opportunity to buy or sell a security from to the other party at a predetermined future date. Means option is similar to the future contract, like in that in agreement between the two parties granting one the opportunity to buy or sell or a security from the other to party to predetermined future date, right? So let's start with the one example, right? So A is the Abhishek, right? And A is the Abhishek, and R is the Rahul, right? So like Abhishek is a, let's consider the Abhishek is a Abhishek wants to buy the flat, right? Buy the flat, and when after the 2 months, right? So and after the 2 months, so today's price is this flat is a 50 lakh, right? And there is some news, and like this property nearby, government making the uh, like government making the highway, right? Government making the highway. So Abhishek speculate the market these prices will be goes up at after the 2 months because of this news, right? But right? So this is an granting, this is a agreement between the two parties, right? So I'll also after 1 month, Abhishek want to the highway will be stopped by the government, and there will be hold from the government side. So he don't want to first like that. This Abhishek, this 50 lakh price is today's price, and after the when the 2 months later. So Abhishek taking the token amount and booking this flat as the today's base, like some token amount some 50,000, right? This is a token amount, right? So Abhishek book this flat as the today's base with 15,000, doing for the Rahul, uh, uh, by sending to the Rahul, and buy this book this flat as the today's base with 15,000, right? But after 1 month, and there will be news from the government side of the highways will be not going this side. So Abhishek don't want to buy this flat after 1 month. So Abhishek has the right to buy or sell this. Means there is not obligation to buy this property, right? Because he don't want to buy. So there is not an obligation to buy this property. So he Abhishek back out from this contract, but he loses the token amount, right? So this is the option contract. Basically, there is no obligation to buyer to buy this property, but in the future contracts there is a obligation for the both parties. So this is basically good example, like today's base, he booking the flat with 50,000 at the predetermined future date, like after the 2 months. So this is an example of the future options, right? And the key difference between the future, that is is that option simply gives the buyer the option to either buy or sell that asset at a certain price date, right? As the future contract, there is obligation for the both parties, but in the option there is no obligation to the buyer to buy this property or to sell. uh, and to the say buyer has the rights also to sell this, right? Sell this property. There is this is one, the option contract, an agreement between two parties to facilitate a potential transaction involving an asset at a present preset price and date, right? The option contract, another one example, the option contract. This is a buyer and this is a seller, right? And this buyer wants to book this scooty at the today's base, and buy this scooty at the today's price up, and he wants to buy when after the 2 months at the today's price. So today price will be 1.5 lakh, right? So but after the launching time, this price will be goes up. So that's why he wants to book this scooty at the today's price in the future date, right? And booking this scooty, not a fully amount but some percentage of this whole total amount, like, and this is a premium. We are seeing that, like, in the option market this is a premium. So, and this is a token amount, like this is the 10,000 amount to book this scooty at the today's date, like for the 1.5 lakh at the future date, right? but after 1 month, like he or she don't want to buy this scooty, so she or he back out from this contract. Like there is no obligation to buy this scooty, right? So that's but he loses the some this premium and token amount also. So this is basically the option contract, and there are two types of the options: call options and put option. Call option and put option, right? In the uh, in the call option, the holder has the right and to buy the underlying asset at strike price and before an expiration. In the put option also, the holder has the right and to sell the underlying asset at strike price and before or expiration. Means both ways the buyer has the right, like the buyer the underlying asset and to sell the underlying. Means both in the both options, holder has the right, right? So uh, uh, and in that option contract, uh, I will one example with like one related to the stock. After that, right? First start with the call option. So basically, what is the call option? Call gives the buyer the right but not the obligation to buy a given quantity of the underlying asset at a given price or before a given future date. So I will explain one more example. So let's example with Amar is a businessman, right? And this is a Amar and this is a Rohan, right? So Amar is a businessman and Rohan is a its own land, right? And there is like some news to from this nearby land government making the road highway, right? So Amar want like these prices will be goes up after the making this road, means after the there is some duration like after the 2 months of this contract, right? So this land price is today's base is 10 lakh rupees, right? So Amar wants to buy this land as the today's price means 10 lakh in the future date means after the 2 months, right? So in the option contract there are the contract like weekly or monthly contract, and the expiry date is the last Thursday of this month. So he wants to buy this property to uh, at the today's price like 10 lakh at the future date, right? And Rohan also needs to money, so that's why he need to sell this land, right? So in that case, uh, Amar buy this land with some token amount, like let's consider 50,000, right? He buy this Amar buy this land at the today's price to giving this to Rohan to some token amount like 50,000, and buying this land after the 2 months for the 10 lakh rupees. But his speculation, what is speculation? After the making the road, the prices will be goes from 10 lakh to 15 lakhs. That's why he needs to buy at the token amount sum. And this token amounts basically this is a premium, right? In the option market, this is called the premium, and this is a some percentage of the total amount. But in the future contract, there is a total amount some like some fixed percentage to this is called a margin. In the future contract called the margin to pay, and in the option market it's to premium, right? First, yeah, needs to buy this premium, but after some time, after 1 month, mm, this road is not making nearby the land, so Amar don't want to buy this land after 1 month. So in that contract, Amar can back out from this contract. There is no obligation, but in the future contract there is obligation for the both parties, right? But in the option contract there is no obligation to buy this land after the like 2 months at the end of the contract. So he can back out from this contract till the end of this contract, right? Before the end of this contract, right? So he loses the some token amount or some premium. So this is basically call option. This is called Amar is a call option buyer, and this is called Rohan is a call option writer. Yeah, this is a call option buyer and call option writer. This is an important line. Buyer the right but not the obligation to buy a given quantity on the underlying asset on a given price on a before a given future date. As I said, like Amar not the Amar has the not obligation to buy this given quantity of the underlying asset at a given price or before the given the future date. He can back out from this contract before the end of this contract, right? And next with the put option, right? Put give the buyer right. In both cases, buyer has the right, but not the obligation to sell a given quantity of the underlying asset at a given price or on before given future date. All the option contracts are settled in the cash. Let's start with the one example, right? So, uh, same name with the example, like A is the Amar and R is the Rohan, right? So, Amar has a some farm like a turmeric farm, right? Turmeric farm, and uh, let's consider Amar has a like a turmeric farm, and R is the buyer, like means R needs to buy this turmeric product, turmeric farm, like R means Rowan, right? So so Amar speculate the like after the 2 months there is some atmosphere wise and the turmeric prices will be goes down, right? So Amar speculate to market will be goes down. That's why Amar need to sell the this palm. Today's price is a let's consider total palm is a 1 lakh rupees, right? So this 1 lakh rupees is today's price of this whole turmeric palm, and he speculate the market will be turmeric prices will be goes down after the 2 months, and when the whole palm is ready, right? So that's why uh, Amar want to mm, contract between these this Rohan to at the today's price like 1 lakh, because he speculated the market goes down, and this market this price is like 1 lakh to maybe 80,000 75. So that's why wants to he want to minimize the losses, and he wants to uh, book this farm as the today's price with future date, means after the 1 month or 2 months at the end of this Thursday of this contract, right? at the stock exchange last Thursday is the expiry date. That's why I say so. But there is no any atmospheric like he wants to 1 lakh and is the today's price, and he wants to book with some token amount he giving to the Rahul, giving to the Rohan with like 10,000 10,000 amount, and book this farm as the today's price with future date, right, to the Rohan. But after the some dates there will be like not happening in the any atmospheric change, and like prices will be not going down. So Amar don't want to uh, sell this farm to the whole farm to the Rohan, right? Uh, Rohan, whole farm to the Rohan. So Amar has the not obligation to sell this whole farm to the Rohan. There is not obligation, and can he can be back out from this contract, and he's losing these some token amount, only token amount, but not obligated to sell this whole farm to the Rohan. So this is basically contract between these two parties, but not the obligation uh, for the Amar to buy this to sell this whole farm. So basically, in that case, Rohan has the obligation to buy this, and in that case, uh, in the first example, the Rohan also obligated to sell, but buyer has the not obligation in that example, and also in that farming example, Amar Amar has the not obligation to sell, right, to the full farm. And in this land example, Amar has not the obligation to buy this land, right? So this is an obligation based difference in between the two parties. As I said, like this is in the farming example, this is called a put option buyer. Put option buyer. Sorry for the writing. Put option buyer, and Rohan is called a put option seller, means, and a put option a writer. It's called a put option writer. As I said, like uh, when we speculate, the market will be goes to call option, right, to buy the stock, and for the seller to obligate to sell stock, right? And but in the when we speculate the market goes down, that time put option uh, like in the put option right to sell stock, but there is no obligation, uh, no obligation in that case. In both case not obligation, and in this both case have the obligation, right? As I said in the farming example, he wants to sell the farm, and he wants to buy, but he Amar don't obligate to sell the stock, but Rohan obligate to buy this stock, like he loses only the premium, right? And this is the good examples for the call and put options. uh, After that, uh, further the options are classified based on the type of exercise. At present, the exercise style can be European and American. So American options are options contract that can be exercised at any time of the expiration date, right? So this an European option are options that can be exercised only at the expiration date. Means there is a difference between the American or European style. These can be exercised at the anytime up to the expiration date, and only at the expiration date, right? So in the American option, you could exercise at any time. This difference, American or European, you could exercise it any time before the expiration date, and they are exercised only on the expiration date. It has more flexibility and they are usually worth more than command higher premium because there is a right to uh, any time to before or the expiration date. They are much less flexible, which means they are usually worthless and command a lower premium than American options because they exercise only the expiration date. They are typically mostly usable in US stock options, and some US index options are European styles. And basically, they are usually traded on exchange, and they are usually traded over the counter. On the uh, Indian contracts, mostly usable the European option style. So I will explain the one more example, regarding to the stock in the option market. So let's consider the Reliance option, right? So today's price is 2,100, and after the end of this contract, this price will be 2,200. This is one case. This is one case, and this is second case. Like today's price is 2,100, and at the end of this contract, this prices will be 18, like 1,800, right? In case uh, today's price is 2,100, and he buy these future options to the future date, like at the end of this contract, and market he speculate the market will be going up, right? And he will be buying, like giving the some premium amount and buy this book this contract, and market, and this has the market will be goes up in the my direction, means market will be going up, then this will be exercise on our side, and this will be making the profit because our speculation is correct, right? And but in the second case, today's price is 2,100, and at the end of this contract, the market will be going to the at 1,800. But right, so our speculation is wrong in the second case. So market will be going down, but we speculate the market will be going up. But in that case, we can't wait for the till the end of this contract. As a buyer, uh, like there is no obligation to wait for the end of this contract. We can back out from this contract uh, before the expiration date, and we minimize the losses. So in that case, our speculation is wrong, but we exercise our speculation is not exercised correctly, so, but we can back out from this contract and losing the some premium amount. So I like this is the basically option contract. After that, like what is the difference between futures and options? I already explained the full of the futures and options. After that, I will explain one by one. Like meaning, future contract is a binding agreement for buying and selling of a financial instrument at a predetermined price at a future specified date. I already explained, like we can we can agreement between the two parties, like with the predetermined price at a today's price at the future date, specified date. But uh, and in the option of the contract, in which the investor get the right to buy or sell the financial instrument at a set price or on or before certain date. However, the investor is not obligated to do so, right? Main difference is the nature of contract. The obligated to buy or sell at a future date. So there is a obligation to once they enter in the contract, both parties can't back out from this contract. There is an obligation, but in the options, option buyer has the right to buy or sell. There is no obligation to option buyer in the right to buy or sell. After that type of agreement, this is a standardized agreement. This is a standard agreement. Both are traded on the exchange traded derivatives. In the right and obligation, both buyer and seller have the obligation, as I said. Both parties have the obligation. But in the options, contract buyer has the right, but seller has the obligation, as I said in the example also in the example in the last videos. Buyer has the right to buy the means not obligation to buy this contract, but seller has the obligation to sell this, right? Execution of the contract on the agreed date at any time before the expiration or agreed date means we can exercise this future contract only on the predetermined future date, only the expire on the future date. But in the option contract, any time before the expiry date, we can back out from the any time of the before the expiration date, as I said in the example. After that, risk and reward, in that is unlimited profit and loss potential. And in the option contract, there is a limited risk and unlimited profit potential, right? In the market participation, speculation, and hedging purpose, in the option contract also speculation, hedging, and income generation wise, right? After the initial investment, the margin requirement apply only. This in the future contract, we need to book this or contract with the today's price with future date. We need to pay this margin as well, like total amount, some percentage of this margin. And option, as I said in the example, also we need to book this amount as a token amount. So this is called as a premium paid upfront. So price movement wise impact the direct correlation with underlying and non-linear relationship due to pricing, right? After that, flexibility wise, less flexibility due to the obligation, and it's more flexibility because there is a obligation for the both parties too. That's why less flexible, and this is a in that option more flexible has its right. Purpose wise, hedging against price fluctuation. Hedging against price fluctuation. Hedging, speculation, income generation, already covered these topics. Example like commodities, stocks, indices for the future contract, and for the option contract, equity options, index option, and commodities. So this is basically what is the difference between these futures and option contract, right? Let's move on to the next. What is difference between equity and derivative market? I already explained in the last videos like what is equity and commodity market. So today's topic, today's video is what is derivative. So that's why I want to explain like what is equity and what is the difference between exactly in the feature wise. So meaning is it is also the cash market, and derivative market, it is also called future and option market, right? Uh, because these are traded on the exchange traded derivative, that's why it's called a FOM market. Key is this is a fundamentally strong and this is a technically strong. Quarterly traded, you can buy whatever quantity you want, right? Because in the equity market, we are the owner of this stock, but in the derivative market, you have to buy or sell in the defined lot size only. There is a future, there is a fixed date, and we need to buy this fixed lot size. Nature-wise trading, you can only buy here except intraday. In the intraday, we can sell also, but otherwise in the you can only buy. And in the derivative market, you can buy or sell both, right? In the purchase, equity asset may be meant for the consumption or investment, as I said last. In the we are the owners in the equity market. In the derivative contract are the for the hedging or arbitrage or speculation purpose wise. Amount required, you have to pay the whole amount of the buy. You can buy in the equity market, we need to pay whole amount. In the derivative market, you can buy or sell by just paying the margin money. As I said, in the future contract need to pay the margin, and in the option market need to pay the premium, not to the whole amount. Holding, you can hold it till whatever you want, but in the equity market, but in the derivative market, you can hold it only till the end of this contract, means weekly or monthly. There is always a fixed expiration date. Ownership wise, in the equity market, what is the purchase with purchase of shares of the company in the cash market, the holder become the part of the owner of the company. As I said in the last uh, features, like we have the stocks, then we have the owner of the company. But in the derivative market, while in the future it does not happen. So there is no not happen. So basically, this is a today's videos discussion regarding to the what is derivative, what are the derivatives, what are the trading ways, what are the types of financial derivatives, and your difference between the futures and option, and the difference between the equity and derivative market. This is basically purpose of the learning purpose. So uh, I hope all of the people are understanding all the information with and also understand the example also. So I will explain in the next videos in the full detail, like what is future and what is option trading. So but in this video I'll give the some flavor of these topics. So thank you guys. uh, so next slide will be thank you, because this is most important. So thank you all the people, please watch these videos and also liking and commenting on that videos, and don't forget to my don't forget to my don't forget to subscribe my channel. So thank you guys again, and thank you, bye bye, take care.